Today, we're going to talk about a paradox that's been on my mind lately, something that seems counterintuitive but has proven true time and time again in financial history. It's this: markets don't usually break when everyone is scared. They break when everyone is looking in the same direction, completely missing the real danger lurking just out of sight. Right now, what's the conversation everywhere you look? It's all about inflation, interest rates, and the Federal Reserve. Will they cut rates? Will they hold? Will they hike again? Every data point, every CPI report, every jobs number is scrutinized and debated endlessly. Cable news, financial Twitter, even conversations with friends. It's all fed. And that's the thing. These risks are completely out in the open. They are visible, they are discussed, and most importantly, they are constantly being priced into the market. Every tick up or down in stocks, bonds, or currencies is, in some way, a reaction to this ongoing narrative. The market is obsessed with it. And that obsession is exactly why these well-known risks might not be the most dangerous ones anymore. When everyone is watching the front door, the real threat is often sneaking in through the back window. Let's take a quick trip through history, because this isn't a new phenomenon. Think back to 2007, just before the great financial crisis. What was the mainstream financial media talking about? Believe it or not, a major concern was rising inflation and whether the Fed was behind the curve. Sound familiar? Meanwhile, beneath the surface, a cancer was growing in the credit markets. Subprime mortgages, collateralized debt obligations, credit default swaps. These were complex, boring topics that most people ignored. The real risk, the systemic risk, was building in the plumbing of the financial system, far from the spotlight. By the time Lehman Brothers collapsed and everyone finally paid attention, it was far too late. The damage was done. Or what about the year 2000 and the dot-com bust? The story then wasn't about risk at all. It was about endless growth. The narrative was that the new economy had changed the rules of investing. Companies didn't need profits. They just needed eyeballs and a com at the end of their name. Valuations were stretched to absurd historic highs, but nobody cared. The focus was on the exciting growth stories, not the boring fundamental math that showed the entire structure was unsustainable. The risk wasn't the economy slowing down. The risk was the collective delusion about valuations. When that bubble popped, it wasn't a surprise to those who were looking at the right numbers, but for most people, it felt like it came out of nowhere. Even more recently, in late 2019, what were the headlines dominated by? The US-China trade war, tariffs, negotiations, tweets. That's what moved markets day to day. But something else was happening quietly in the background. In September of that year, the repo market, a critical but obscure corner of the financial system where banks lend to each other overnight, suddenly seized up. Rates spiked, and the Fed had to intervene with massive injections of liquidity. It was a clear sign of deep stress and a lack of cash in the system. While everyone was watching the trade war drama, the financial system's plumbing was already clogged. A few months later, when the pandemic hit, this pre-existing liquidity stress turned a health crisis into a full-blown financial panic. The trade war was the distraction. The liquidity issue was the real vulnerability. So, where does that leave us today? If you just look at the surface, things seem pretty calm, right? The VIX, the market's fear gauge, has been remarkably low. Stock market indices in the US are hitting or nearing all-time highs. Confidence feels like it's slowly but surely returning. It feels stable. It feels safe. But when you start to look beneath that calm surface, you see some strange and unsettling signals. You see signs that risk hasn't actually disappeared. It's just shifted into less obvious places. Let's talk about liquidity. It's incredibly uneven. A handful of mega-cap tech stocks are getting all the love and all the capital, driving the major indices higher. But if you look at smaller companies, or different sectors, or even international markets, the picture is much less rosy. Many assets are being left behind. This isn't a broad, healthy, all ships rising kind of rally. It's a narrow, concentrated one. But we're also seeing a strange disconnect between prices and participation. Prices are going up, but trading volumes have often been surprisingly thin. This suggests that it doesn't take a lot of buying to push the market higher, which can be a sign of a fragile market. There isn't a huge wave of conviction driving this rally. It's more like a steady, low-volume drift upward. And what about the big players, the institutions? Publicly, the sentiment seems bullish. But if you look at survey data and positioning reports, many large institutions appear to be quite cautious. They're holding more cash than usual or using complex hedging strategies. It's a classic case of do as I say, not as I do. While the retail crowd might be jumping back in with both feet, the so-called smart money seems to be keeping one foot near the exit. This brings us to a really dangerous dynamic, when confidence returns faster than the underlying fundamentals. The economy is okay, but it's not spectacular. Corporate earnings are decent, but not booming across the board. Yet market sentiment has recovered with incredible speed, largely thanks to the excitement around AI and the hope of Fed rate cuts. When psychology outpaces reality like this, risk doesn't fade away. It just concentrates. It hides in the assumptions everyone is making. The assumption that the Fed has it all under control, the assumption that a handful of tech companies can carry the entire market indefinitely, the assumption that the low volatility we see today will last forever. This is where looking at alternative signals becomes so important. And I'm not talking about trying to predict the exact price of gold or silver tomorrow. I'm talking about using these assets as a barometer for something deeper: trust. Hard assets, like precious metals, often react to subtle shifts in the financial bedrock. They don't move because of a hot CPI print. They move when underlying confidence in currencies or financial stability begins to quietly erode. When you see gold making new all-time highs even as the dollar is strong and real interest rates are positive, that's not a normal market relationship. That's a signal. It's a signal that major players around the world, like central banks, are diversifying away from traditional financial assets. It's a quiet vote of no confidence. Silver, which has both monetary and industrial properties, can also be a fascinating indicator. It often lags gold, but when it starts to move with conviction, it can signal that a broader recognition of these underlying shifts is starting to take hold. These aren't panic indicators, they are trust indicators. They react not when the headlines are screaming sell, but when the quiet foundational beliefs that hold the market together start to change. The real danger, then, isn't what we're all talking about: the inflation numbers, the Fed meetings. Those are known variables. The real danger is what no one is pricing in. It's the risk that liquidity is far more fragile than it appears. It's the risk that market concentration has become a systemic vulnerability. It is the risk that geopolitical tensions could flare up in a way that no economic model can predict. When all investors, from the retail trader to the giant pension fund, crowd into the same narrative, AI is the future. The Fed will save us. The market stops being a mechanism for discovering prices based on reality. It becomes a mechanism for reflecting agreement. And history shows us very clearly that moments of broad, unquestioning agreement are almost never the safest times to invest. They're the moments just before the narrative breaks. I'm not saying the market is definitely wrong. The rally could continue. The economy could reaccelerate. But the odds are stacked against a future where everything goes perfectly according to the popular script. The market might not be wrong, but it may very well be looking in the wrong direction. The biggest risk is assuming the biggest risk is the one everyone is already watching. The lesson from 2000, 2008, and 2020 is to pay attention to the silence. Pay attention to what's not being talked about, because that's where the next big surprise will come from. Thanks so much for watching today. This is a complex topic, and I'd love to hear your thoughts. What risks do you think the market is ignoring right now? Let me know down in the comments. And if you found this video valuable, please hit that like button and consider subscribing for more content like this. It really helps the channel out. Stay curious, stay critical, and I'll see you in the next video.